Welcome to Money Mode, the channel that makes money talk less confusing and way more useful. Let's get into it. Every time inflation makes headlines, one word gets repeated everywhere: gold. For centuries, people have turned to it as protection when currencies lose value. But does that reputation still hold up today? Or is it outdated advice from a different economic era? Let's look at what the data actually shows. First, let's understand why gold earned its safe haven title in the first place. Unlike paper currency, gold cannot be printed by central banks. Its supply grows slowly, roughly 1 to 2% per year through mining. That scarcity is the foundation of its appeal. When governments increase the money supply and prices rise, gold is often expected to hold its value because it isn't diluted the same way currency is. History gives us a famous example. During the 1970s, the United States experienced double-digit inflation. Over that decade, gold prices surged dramatically, far outpacing the rate of inflation itself. This single period cemented gold's reputation as an inflation hedge in the minds of investors for generations. But here's where the story gets more complicated. If you zoom out and look at other inflationary periods, gold's performance becomes much less consistent. In the 1980s and 1990s, inflation remained moderate, yet gold prices actually declined for long stretches. During the 2021 to 2022 inflation surge, one of the sharpest in decades, gold's price moved sideways for much of the period, even as consumer prices climbed rapidly. Meanwhile, other assets like energy stocks and real estate outperformed it. So why does gold sometimes fail to track inflation? A few reasons. Gold generates no income. It pays no dividend, no interest, no rent. Its price is driven purely by supply, demand, and investor sentiment, not underlying cash flow. When interest rates rise to fight inflation, holding non-yielding gold becomes less attractive compared to bonds or savings accounts that now offer real returns. That competition can suppress gold's price even during inflationary periods. There's also the matter of timing and expectations. Markets tend to price in inflation ahead of time, reacting to forecasts and central bank signals rather than waiting for official reports. By the time inflation numbers are officially released, much of gold's reaction may have already happened months earlier, based on anticipation rather than the headline data itself. This is one reason gold can feel unpredictable to short-term traders, even when its long-term logic remains sound. Then there are practical costs. Physical gold requires storage and insurance. Buying and selling it often comes with markups and spreads that eat into returns. Gold-backed exchange-traded funds solve some of these issues, but they introduce management fees and counterparty considerations of their own. So does that mean gold is useless? Not exactly. Its real strength isn't as a precise inflation-matching tool, but as a diversification asset. Gold tends to have a low or even negative correlation with stocks during periods of financial panic. When equity markets crash, gold often holds steady or rises, which can cushion a portfolio's overall losses. That's a different job than beating inflation dollar for dollar, but it's still valuable. Modern investors also have other inflation-fighting tools that didn't exist decades ago. Treasury inflation-protected securities, or TIPS, are bonds specifically designed to adjust their value with inflation. Real estate can offer rental income that tends to rise alongside prices. Even certain stocks, particularly companies with strong pricing power, can pass rising costs on to consumers and protect their profit margins. The smartest approach many financial professionals suggest isn't choosing gold instead of other assets, but combining it with them. A small allocation, often cited in the range of 5 to 10% of a diversified portfolio, can provide a buffer during crises without over-relying on an asset that generates no income and can stay flat for years at a time. So is gold a safe asset in an inflationary world? The honest answer is, it depends on your goal. If you're looking for a perfect, guaranteed inflation hedge, gold's track record is far more mixed than the folklore suggests. But if you're looking for a stabilizing piece of a diversified strategy, one that has held cultural and financial trust for thousands of years, gold still earns its place at the table. This video is for educational purposes only and does not constitute investment or financial advice. Always do your own research or consult a licensed financial advisor before making investment decisions. If you found this breakdown useful, subscribe for more clear, no-hype explainers on how money really works.